Good afternoon, all. I am Abhishek Shankar. I welcome you all to this webinar. We will wait for 2 minutes to start the session. We are still ahead of time. Good afternoon, all. I, on behalf of Marsh India, welcome you all to this webinar, Bridging the Financial Gap with Insurance Product. I am still seeing a lot of participants joining this webinar. So we will again give 1 more minute and then we'll start the seminar. A very good afternoon to all the participants. I am still seeing a lot of participants joining the webinar, but considering the time, we will start the webinar. So welcome you all. I, on behalf of Marsh India, welcome you all for this webinar, Bridging the Financial Gap with Insurance Product. The private sector is emerging as a key player across various construction segments, ranging from roads, communications, to power and airport. Investment from private sector into physical and social infrastructure is the key that will make India a US 5 trillion economy by 24-25. For these private sectors to leverage these opportunities, the construction industry will need to scale up its capabilities on several fronts, especially the resources required to procure bids and to see the procure bids through completion. Considering the asset-light nature of the industry, there is a gap between capital required and the finance options available. We believe the latest regulations of Trade Credit Insurance 2021 and Surety Bond 2022 will help us bridge this gap. We all know the definition. Surety bond is a guarantee issued by third-party insurer or surety in favor of beneficiary, creditor, or project owner on behalf of principal contractor. Marsh India is the front runner and has been advocating to have surety product in India as an alternate to bank guarantee. And we are very close to see this product live very soon. We are proud to state that we have been instrumental in some large placement for some of our large clients. Developed nations have migrated long back to surety, and Europe and Africa, both bank guarantees and bonds coexist. While we are sure that the product will be live in April 2022, however, we are certain that from H1 22, we will see some large insurer writing the business for Indian clients. Overseas, this has always been an alternate against bank guarantees, and now it will be soon available in India. Bank guarantees or bonds are the most commonly heard topic for large projects and also in government projects. We are all eagerly waiting to see how the product performs in India and how the insurer react to raising demand and substitute for as bank guarantees. Indian business is growing hugely, and it's becoming difficult task to manage rotation of funds by the CEOs, including the project finance team. While most of us present here would be aware about the product, but there is a lot of other important points that needs to be understood with this new product coming in India. How will the product look and feel? What are the features? How it will be accepted by the insurers? What are the capabilities available? What are the capacities that are available? What are the measures by the regulator to protect the policyholders' interest? And hence, we have organized this webinar today. A short instruction to using Zoom, which is there on the screen. If in case you have any question that you wish to post, you can use the question answer tab. In case you want to personally ask those questions, you can raise your hand and we will try to unmute your line. There are poll questions and we would request all of you to participate actively on those poll questions. Next slide. The topic for today's discussion is primarily on two important aspects: surety insurance solutions in India and receivable finance and non-payment insurance. For this, I would like to invite our speakers for today's call. Taylor comes with an experience of 24 years across America and Asia in structuring trade credit solution across industries and sectors for corporate and big bank across the world. We have Lynn, who is a regional practice leader for Marsh Africa Surety and Political Practice. She is responsible for business development for the surety and political risk portfolio in our Marsh office in South Africa, as well as rest of Africa. She covers a variety of industries, including construction, mining, power, and manufacturing. Lynn manages relationship with many of the leading underwriters across Africa. She has over 20 years of experience, out of which 11 years she is handling surety and political risk. I have with us Akshay Bhardwaj, Senior Vice President, Practice Leader, Credit Specialty for Marsh India. 17 years overall experience and 8 years managing and handling trade credit and political risk, structural finance and sureties in India. He has been a strong advocate and facilitator on liberalization of trade credit guarantee and introduction of surety in India. We are delighted to announce that we have representation from one of the large corporate house, and I'm excited to introduce Mr. Chandrapal Singh, Head of Insurance, KEC International Limited. He comes with a diversified experience of 20 years in finance, insurance, and risk management of infrastructure companies, presently heading insurance function of KEC International Limited and managing global portfolios. And I am Abhishek Shankar, Executive Vice President and Construction Practice Leader for Marsh India. 16 years of overall experience, including underwriting claims and over 11 years with Marsh. I am responsible for construction business in Marsh India and works closely with some of the large contractors on complex projects ranging from hydro, thermal, port, metro, high-speed, nuclear, and even green hydrogen. With this, I would like to hand over to Akshay to take us through the webinar.
Thank you, Abhishek. So we start with the first poll question. The question is, how important would it be to increase the non-funded lines without additional pledge on assets as collateral. The options are very important, important, not so important, and not important at all. So the vote goes from there's a tie. The majority votes are between very important and important. So obviously this becomes a very strong point, and I think that justifies our session today. There is second poll. What is, in your opinion, is the biggest challenge for an Indian contractor? Now, the options are safeguarding against counterparty and country risk, easing of cash flow, cheaper non-funded lines, and maintaining a competitive advantage in competitive market. Okay, I think we have unanimous. Okay, the lines are moving. Okay, so we have about 80% saying that, okay, they want to safeguard their risk and ease cash flow. And obviously, 10% maintains that having non-funded lines which are cheaper, more competitive is important, and obviously maintaining a competitive advantage. And this is the last one, so it's more of a webinar, less of a question answer session. Third is, does your banking consortium calls for collaterals for better funding structure? You can opt between yes or no. Third poll, please. I think this is more of a unanimous choice, barring a few. Okay, so we have 94% people voting that yes, there is consistent requirement for additional collaterals to improve the funding structure. So what I'll do is I'll just take you quickly through the brief of the product, and then we can have a question answer session with our esteemed panel. Broadly, what surety is? Surety is a surety bond is a guarantee issued by a third party, which is typically an insurer, in favor of a project owner on behalf of principal debtor or a contractor. Now, what surety bond guarantees to the project owner is that the contractor will fulfill the terms of the contract, whatever be the contract. Second is it's a sort of a pledge from the insurer, or what we call surety when they provide surety bond, that if the contractor do not honor the obligation, they will make good the loss to the principal. So these are two very fundamental, or these are the easier way to understand sureties. Now, when we talk about what surety does, it can act as an alternative to bank guarantees. It can also work in collaboration with bank, which my friend Abhishek was speaking about, wherein you can give a surety as an alternate to a bank guarantee. Globally, in many markets, it also coexists, and bank surety syndication is a huge business for Marsh. Globally, it's a very big business where banks and surety companies come together to give guarantees on behalf of their clients. Now, the question which I keep on getting asked is that why probably a surety is more popular than probably a bank guarantee. And I think the core of it is the way it is underwritten. Now, if you look at a bank, they are typically what we call, they do asset-based assessment or asset-based underwriting. So the weightage on objective parameters like your P&L, your profitability, net worth, etc., and what type of collateral you are giving is very heavy, probably maybe 90%, and 10% is on subjectivities. Now, if you look at an underwriter of a surety who works on the probability of loss, and I think this is how broadly the two differ. Now, when a probability-based assessment is done, there is a larger weightage on subjective elements. Your past track record, what type of guarantees you have given, etc., they have a larger weightage. The difference it creates is, one, it is flexible. Two, the same balance sheet, if a bank is looking at it and is ready to give, say, $100 line of for bank guarantees, a surety underwriter may be able to do 120, 150, or maybe 200. Okay, and the best part is because it is basis probability based assessment, the requirement of collateral is not there. I'll delve on it further. So I think this is where a surety fits in terms of a product. Now, to understand the relationship between parties in surety bonds, so there is a project owner. He awards a contract and demand bonds. It can be a BG, it can be a surety. Let's say sureties. You mandate Marsh. We reach out to the market and find an insurance company which can help or provide the right surety. Now, the insurer, when they, before issuing a bond, they sign something called Indemnity Agreement. In terms of insurance, you must have heard that when a claim is paid, at that time you are asked to sign an indemnity, but in surety, it is signed upfront. And the thought is that this indemnity document says that in case the surety is invoked, I will come and collect the money from the contractor. Now, once this is done, the bonds are issued. Now, God forbid, if there is a failure from the contractor in terms of breaching the overall contract, then the contract owner or project owner goes to the insurance company and invokes the bond. And once the bond is invoked, the insurance company will go to the contractor to exercise their subrogation rights. So I think this is what broadly the relationship is between various parties. Globally, if I look at it, Marsh is a very big player, and globally in sureties, we are the largest. The whole idea of, while in India it is new, and we have Lynn with us, we have Mr. Chandrapal. They both have been very strong advocates of this, and Lynn had 6 years back, she has started working on this. Okay, so broadly, there are 3 or 4 ways in which we can help internationally for Indian contractors. One is where an insurer issues a direct surety on your behalf. Second is sometimes there is a requirement in certain countries that they want local insurer to issue the surety bond. We can also arrange an insurer issue a surety bond via a local company, which we call fronting. Third is where the principal insists on a bank guarantee. We can get the surety back a bank or give surety as a collateral for the bank to issue guarantees. And fourth is, if there is a iteration where they want a local bank to be issuing a bank guarantee, we can also do it wherein we give a surety to a bank gives surety to the local bank in the country, and they issue a bank guarantee. Now, difference between bank guarantees and surety, I'll just take a few more minutes. In terms of security, bank guarantees are typically collateralized. They also ask for additional margins. Sureties are usually collateral free. Thus, it frees up your asset class, which can be used for maybe funded lines or some other usage. Qualification, surety, as I said, or bank guarantee, as I said, requires a thorough assessment on objective parameters, or what we call asset-based assessment of a contractor. A surety also does it, but they also look at your subjective parameters in terms of your past performance, what type of expertise you have in a project, who is the principal, who are the promoters, etc. So this part, or what we call subjective part, is given equal weightage or more to ensure that surety companies are able to give more lines. Duration for both, it is in line with contract. Pricing, pricing varies, so it's not fixed pricing with respect to how a bank guarantee is priced. It depends upon your financials, duration, etc., and what type of collateral you are giving. Similar for sureties, it depends purely upon the contractor's subjective and objective data what we receive and the duration what we are looking at. In terms of invocation, banks normally have a collateral, so God forbid if there is an invocation of surety, they will immediately debit your account or take care of the collaterals. In a case of a surety, as I shared with you earlier, there is an indemnity document which is signed. So in case if there is invocation, they will exercise subrogation and will come and collect the same from the contractor. Why sureties? One, obviously it creates additional capacity. Second, it reduces your dependence on banks only. Third, many markets, like if you talk about Americas, which is like 100% surety, and that too not from today but 1930, it diversifies your source of guarantors. You are not dependent only on banks, but you have insurers as well. Frees up your lines of credit. And generally, if you see, most of the sureties are conditional, where before invocation, the principal has to admit that there has been a default by the contractor. So even if a surety is invoked and there is an admission, we have a legal case against the principal if it is wrongfully caught. So I think that makes it a safer instrument. Now, if we talk about India's side story, what IRDA has done with the new guidelines, they have allowed contract bonds, that is your bid, advance, performance guarantee and retention bonds, custom bonds and court bonds. So these are the three classes of bonding which is allowed in India, but they have not allowed financial guarantees. Okay. Second is surety in India would be defined as a contract of guarantee under Section 126 of Indian Contract Act. Rather having a facility, what probably the regulators thought is that they would want the surety to be issued project wise, not as a collective of various projects, and the sum total of the sureties at any point of time or the peak exposure should not exceed 30% of the project value, which I find is fair because I have not seen much exception in this. These guidelines are for only Indian sureties, and I said, as Marsh, we can help you with your international projects, but these guidelines are purely for Indian contracts, and the surety would be issued in INR. Now, two things they have come out for purely from insurance perspective or insurer's perspective. One is the thought of regulator is that this particular surety business should be handled by only those people who have strong financials. So IRDA talks about a solvency margin of 1.5. For surety, the company has to have a solvency margin of 1.25 times of the control level. So that is 1.85. And second is there is a cap so that there is a no risk concentration. Because so insurers can write either 10% of their total premium in a year or 500 crore, whichever is lesser, in terms of surety premium. Now, to delve further, when we talk about the point where I was talking about 1.25 times of control level, broadly, this is the list of about 13, 14 underwriters who qualify to write surety out of 35 plus non-life insurers. In terms of demand, the demand will come not only from contractors, but I'm seeing principals, because government has mandated that all central government agencies, PSUs, they will start giving you choice to give either a bank guarantee or a surety from 1st of April. Now, in terms of opportunity, it's a great opportunity for infra companies, for real estate companies, for energy companies, for anybody who's into long-term contracts and anybody who is required to perform and give a guarantee. So this is a huge opportunity. Now, in terms of way forward, I have interacted with many of you earlier, and there are a few pointers which have come in, and this is also from underwriters, which they are trying to sort in. One is underwriters are looking at being given a right of a financial creditor than an operational creditor in insolvency and bankruptcy court. The idea is that they would want easy resolution or faster resolution in case a contractor fails. Second, they wanted some regulation with respect to easy subrogation when a contractor fails. So that is one part. Second is the industry expectation is that there has to be a robust reinsurance support, because this is a reinsurance driven product. Something similar to like what we have a SBA surety bond guarantee scheme in US, where government also supports surety companies. Third is to avoid fraud, because this is a quasi-financial product. To avoid fraud or to ensure that nobody is over leveraged, one ask from industry is that there should be a data sharing between banks and surety companies, basically CIBIL or CRILIC database, so as to ensure that somebody is not misusing sureties or somebody is not misusing bank guarantees or there are any shadows. Rather, it should be open and transparent. So that's all from my side on surety side. Now I will probably ask my colleagues to join in, Mr. Chandrapal and Ms. Lynn, for a small question answer session where I would be seeking their views on certain points. So, Mr. Chandrapal, Ms. Lynn, if you can come forward. Thank you. So that was all about the product. Thank you for taking out time. I know, Lynn, you have 6 years back, you saw the potential. You came to India with the underwriters, and last 6 years we have done it. So yeah, it is just round the corner. Mr. Chandrapal have utilized sureties across various geographies. He was able to set up surety lines in South America for his company, in other parts of the world. So we will benefit from the interaction. So first question, how excited are you with these new surety guidelines? And will there be a local demand and rush to utilize sureties or other conventional tools? And how will it benefit Indian contracting and construction industry? And this is to you, Chandrapalji.
Right. So first of all, thank you, Akshay, for inviting me. And you wonderfully explained the gist of this entire structure which has been created for the infrastructure market in India. So if you ask me about the guidelines, I would say it is basically a great sign of relief for entire sector and a welcome move for overall growth of entire infrastructure as well as economy. Or rather, I would say this is need of the hour, and we were waiting since long. And I think you clubbed 2-3 questions. So
no, I was just trying to understand what is the expectation of the market? Will there be a rush? Because I'm getting a lot of questions.
So if we talk about the rush, basically we need to understand the industry prospects and the future vision of the government. If you talk about the last 2-3 years budget speech, you will find that emphasis has been given on infrastructure only, and every year the allocation for this specific sector has been increased. And with the increased allocation, and it is not for a specific segment, but across all segments of infra, rather it is oil and gas or power or green corridor or railway, civil, everywhere you will find increase in budget. So government is very, very clear that in next 4-5 years, we are going to build a robust infrastructure for the country. Parallelly, the industry is also ready to take the opportunity. So you can understand the demand.
No, it's huge. But I know if you are intending to become a $5 trillion economy, then the infrastructure will play a major role. And if government is talking about trillions of dollars of contract, there is going to be at least, so 1 trillion means about $200 billion of guarantees. So the amount of demand is huge. Lynn, any thoughts on your, because you have been observing Indian market for long, you have been seeking support for Indian clients. So your views, how do you think?
Akshay.
Yeah.
Yes, well, thank you, and good day to everyone. So yes, I think these recent developments, yes, absolute wow. I'm excited about this, and this really stems from my involvement with Indian clients and contractors, and for us providing various surety solutions on the African continent. Sitting here in South Africa, our surety insurers, just to back up a little bit, you know, South Africa and the rest of Africa, in fact, was predominantly a bank guarantee market, right? And then we had a surety insurer in the 1990s that, you know, came into the market as an alternative to bank guarantees. And for all the reasons mentioned in your slide, Akshay, where he talks about the differences between bank versus surety. And this was an interesting, you know, change in the market where you had an alternative and the advantages that we've alluded to. So, so traditionally it was South African insurer in South Africa, and then they were got a little bit more innovative and we explored into Africa and the rest, you know, the rest of the continent. And then we got even more innovative because it was a product that proved its, you know, its worth, its value to beneficiaries, to contractors. So then the South African insurer started to then explore international clients, international contractors. And as you know, with the infrastructure and the development in Africa, we had to then take a view and look at underwriting these foreign international contractors. And our lead insurer here in South Africa did that. So back in 2014, And again, it still remains our flagship. India clients and India client base will always remain our flagship, right? Something we're very proud of to have tapped into the market back in 2014. To be honest, we worked on from 2014 till about mid 2016, thereabout, just under 2 years to actually, perfect the indemnities, understanding, being in India itself, trying to understand the nature of these clients. And I'm proud to say that, why I'm so optimistic and not there on the ground in India, but sitting here, based on our experience in providing solutions for various Indian contractors on the continent, it's been successful. Whether we've replaced, some clients have come to us to say, listen, we've seen the benefit. These are new projects, but we've got existing bank guarantees. How can you help us to look at easing up that cash flow? Can you replace it? So yeah, very excited. And, it's proven that the product works, beneficial to the contractor, beneficiary satisfied. And yeah, we provided solutions.
No, thank you. Lynn, this is just one more add-on to the what you have said. See, you have been a very strong advocate of Indian market, and you have rallied a lot of underwriters to support Indian clients. Back home, because obviously this news is shared with everyone, and these guys have, together we have delivered almost $600 million of sureties for Indian clients. Yeah. What is the possibility of seeing these guys coming to India to set up shop or support Indian insurers? Because they know Indian companies, they know their track record, they have supported them. So what are their thoughts?
So at this point in time, as I've been alluding to, this one insurer that stepped out of the comfort zone, first from South Africa to Africa, and then looking at underwriting Indian contractors. So of course, they know these Indian clients. They know the caliber of clients. They've had experience with them in terms of execution of projects on the continent. So yes, I might be, talking from an insurer perspective, why not, right? So there has been interest in the fact that they've perfected this angle from India into Africa. The other angle is just being local. So for me, and looking at opportunities of even the same insurer setting up shop on the ground there, because as you know, on the ground is where things happen, right? So you physically, I think we've proven, we come to India all the time, meeting with the clients is paramount, right? So these insurers here are actually looking at this as an opportunity. And as you know, when you were, gathering information for the regulator, these insurers and ourselves, between your offices and mine, we're very instrumental to gathering the information to showcase, listen, this is what the product can do. So definitely, yes, very positive that they would look at that angle going into India and physically.
No, I'm equally positive, Lynn. Mr. Chandrapal, the next question goes to you. This is about Africa's story. We would want to hear your story because I know you have interacted with these guys for long, especially South America. I just wanted to, maybe you can share with our clients over here why BG was chosen vis-a-vis or over BG, why surety was chosen, and what was your experience with these guys, South American on Indian corporates? Because at the end of the day, these people are going to come to India. So, yeah.
Yeah. So, Akshay, we need to understand with the perspective of the insurer side or the mindset of the underwriter, where they basically not aware about your capability or the acceptability. So that was the biggest challenge, how to show the acceptability in the market and to convince these entire market, the technical background of the company and the sound financial and the robust technology expertise, which basically help to understand the market. And if I talk about my own experience, when we enter in the market, the biggest question was how to trust on the company which have never worked in particular region or country.
Correct.
So that was the biggest task to convince the underwriters. Then we met multiple underwriters and convinced on the various aspects of the past track record. Then the question came whether this will be beneficial for the company with respect to the bank guarantees in that particular market. So yes, it was very beneficial. We did a lot of calculation exercise on the basis of the availability of the statics in the market, and basically the biggest benefit, or what would say essence of this product, was uh, providing security without collateral,
Correct.
especially in the
Correct.
country where you do not exist, or the particular underwriters are not very sure whether you will be here for long run or not.
Yeah.
It was a challenge.
So I remember you even told me, I also know that the amount of traveling which you did at that time, you were almost living there. You could have got resident visa also. And the amount of work which was to be done. I also understand that you did backward integration, reaching out to the reinsurers of those insurers to give them comfort. And I think that was very important. So thank you for this. One point which, and basically, I think it is all about making people aware of what Indian contractors are delivering across the world. And
Correct.
there might be initial hiccups, but they do fall in line because they are seeing the amount of potential in the work which you are doing across the world. So I think that learning which they had and the work which you guys have done probably will help us in India when reinsurers are looking at Indian corporates. I think that would be a positive thing. One additional question is with respect to, I have shared with you the pointers on the new guidelines, and Mr. Chandpal, you're well aware. Lynn, I've shared it with you also. Are there any missing pieces in this puzzle? Means, do you think that these guidelines are perfect, or do you think that there is something which extra needs to be done? Because what I understand, even regulator is very positive about it, but they want to listen it from us or from the industry. So anything which you think could make things slightly more better, more faster, more easier, so that underwriters are interacted. Lynn, maybe you can start and Chandpalji can support.
Yeah, I think, to your point, Akshay, these things take time and it has to be proven. They want to see, the client wants to see the benefit, right? And then you're going to buy into it. So I think we need to understand from a timing perspective that it is going to take time. Like ourselves here sitting in Africa, it took almost 18 to 24 months to actually perfect this. I do think things to ease up and in these infancy stages and where it's important that we can say to the regulator, wordings, for example, that is very important, where on a performance bond, advance payment bond, that is a whole legal back and forth between the contractor, the beneficiary, and then the insurer's legal team gets involved. And we find that it delays the process quite a bit. And we all know in construction and in bonds, it's always last minute. They need a big bond, they need a performance bond, and you really, really have to deliver, right? So I think if we can predetermine those wordings and standardize them, that it just makes a whole workflow, and having that whole Indian legal system behind that, perfecting from an indemnity, the recourse, all these things, which is, the timing is now. If we're starting off on the right foot, and
So
if we can perfect
2 points. Yeah, I take 2 points. One is obviously standardization of the guarantees, and second is obviously legal system. Mr. Chandrapal, any thoughts from your side, which could be a missing point?
Also fully agree with Lynn and you that although it's very early to speak about the missing point, especially with the mindset of the user or the industry, because the guidelines doesn't speak much about the user. Largely, it has been issued for the underwriters. So the one thing which Lynn emphasized, that which I also basically experienced, the standardization, which was the biggest hurdle. So this must be considered in mind while issuing the revised guideline, that the product should be standardized, and government is also equally need to emphasize on the standardized format across all the departments or all the business segments.
So that will take off the pain. Actually, Abhishek has just told me that he would want to ask one more question, which he's getting, like everybody's asking him. Yes, Abhishek, last question for
I'm
this
seeing
session.
a lot of question popping in after the theory that we have discussed, that there is a constant question on pricing of surety. Though Akshay, we have already shared the pricing of surety should not be only considered when comprising when comparing the price with the BG. What advice will you provide at this platform that the company should take into consideration when assessing the benefits of surety over BG?
Lynn, Chandrapalji, anybody? It's about
Yeah.
pricing.
So, Akshay, I think it's just like making cattle in the air. While we don't have any clue about the implementation or the product final structuring, but with the mindset of the industry, what we are looking for the implementation is definitely that it should be the cost effective, especially every time we are comparing with the bank guarantee.
Correct.
So we need to factor that the product should be competitive with the existing arrangement.
Correct.
To compete the market, the first and foremost important thing is the cost.
So that's an ask from the industry. Lynn, how do you you have been through this? So how do you compare when somebody is looking at the pricing of surety? What should be the pointers they should think of?
So I think, I'm sure you're sharing your slides, actually, which is quite important to see the benefits. Lots of the clients will say, no, we're not paying collateral, but with a banking facility where you issue guarantees, if you're issuing $100 million bond, that is ring fenced against your facility. And that can have huge cash flow constraints. Whereas if you're looking at surety, providing a surety bond, and I'm looking at our Indian client base, there is no collateral on any of our Indian clients, okay? So that immediately, those lines immediately frees up those banking lines. It's a massive impact on any business, right? And then the $1 million question on pricing. And again, I'm talking from an Africa perspective. It's far and wide. We've got a range which I'll give to you. But again, remember, it's country risk. So I'm talking about a risk on an infrastructure project or a bond in favor of Ministry of Health in the country. So we've had a range of around about 0.5% to about 1.5%. And that's an annual rate that's applied to the value of the guarantee and for the tenor, the duration of the guarantee.
Correct.
So,
so broadly, what I understand is it's basically when you look at BG replacement. So the pricing of BG plus cost of collateral and cost of margin. So when you're comparing with surety, these are the three things which you should be looking at if you are comparing it. So this was my last question. I'm getting a hooter internally that we have to put in the next session.
Akshay, just to add one more thing, on pricing side, generally the market perception is little different. They are basically seeing surety as a replacement of BG, while the fact is that this is smart alternative.
Yes.
So cost will always be the key point for comparison, but this is an alternative and BG will always be exist, and somewhere it may be the beneficial also.
No, thank you, Chandrapalji. I think this is very important. People don't understand or probably are because it's a new product. But yes, it is not just a flat replacement, but still a smart alternative. It enhances your overall portfolio. So with this question, thank you, both of you, for coming up. I'll move to the next part of it. But please stay because there are certain questions and we have a Q&A session after this. So some questions might come in for you. I would invite Tyler at the forefront as I start the second part of the presentation. This is about receivable finance and non-payment insurance. What has happened in the new guidelines with IDA is that IDA has allowed, and earlier it was not there, they have allowed contractors to buy a long-term single buyer policy. And they have also allowed assignment of the policy in favor of a banker to avail in invoice discounting, or as we call factoring, for invoices which have been raised, and there is a waiting period of 60-90 days for a contractor. 60-90 days additional delay makes a lot of difference, and if those invoices can be discounted, then why not? And our regulator have been kind to do that, so we thought we'll do a small session on this as well. Broadly, what it is called is a non-payment insurance. It protects an EPC company not only against the failure of the project owner to make a scheduled payment, but it also can be assigned to a bank to seek finance on the raised invoices. The Marsh standard NPI policies are generally CRR compliant. The pricing is on the peak exposure and not on the project value. We have partnered with the global law firms, and the product what we have as Marsh is Basel III compliant, so banks can draw comfort. I think that makes a lot of a difference for when we are putting up the policy wording to a bank to finance it. In terms of coverage for the product, the policy, what it covers is commercial default of the contractual counterparty for pre and post shipment risk both, along with the financial obligation of counterparty as per the contract. So if they fail to deliver, if the contract goes bad, then you are protected. Nonetheless, because you have assigned the policy in favor of bank, you can also avail finances against those invoices. Broadly, policies are very tightly designed and do not have major exclusions. But what it typically excludes is anything which is illegal, any mistake or performance risk of the contractor, and if there is a dispute. So broadly, these are broad exclusion, and obviously we can go deeper into it, but broadly, these are the exclusions. Now, if I give you a perspective of the deal flow, there is a principal. He has a contract with a construction company. The construction company purchases a non-payment cover on the principal, assigns the policy to a bank, and enters into a receivable finance agreement. On the due date, the principal, when you raise the invoice, the bank pays the contractor, and on the due date they collect the principal. So sorry for this error. It should be 4 and 5 over here. In case of a non-payment by the principal, it is bank who will help the contractor to file a claim, and they will take it up. So overall, it makes a hell lot of a sense. The reason why these two segments or those two things have come up, one is obviously surety part, and second is with respect to this new amendment in the credit insurance guidelines, is purely with respect to the amount of money which is being pumped on the infrastructure side. There have been a demand from the industry that we seek capital reprieve. We seek some support not only on non-funded lines but also where we have raised the invoice, so that we have more cash flow. We'll be able to bid more. We'll be able to raise more capital. We'll be able to deliver more. So I think that is the broad idea. Now, having said that, I would not take much of the time because we have a limited time for this. I would request if I can have Tyler on. Hi, Tyler. Thank you.
Hi, actually. Can you hear me okay?
Thank you, Tyler. Yeah. Okay, Tyler, means you have been pretty involved in this whole exercise. So what new guidelines have done is that they have paved way for contractors for two very important things. One is now contractors can take domestic single buyer contract frustration cover, or NPI as we see. Second is they can assign the policy in favor of a bank and available discounting. My question is, for the benefit of everyone, are these covered popular globally? And do you think banks will have appetite for these type of deals?
Okay, thanks, Akshay. And first of all, thank you very much for inviting me to attend the webinar today. It's obviously on a great topic, something that obviously it's quite an interesting topic and very relevant, judging on the number of attendees we have today. So well done to you and the team for hosting, and thank you again for inviting myself to speak here today. So it's a great privilege to speak to everyone here, and I hope everyone is safe and staying well as well. Just in answer to your question, in short, yes, there is certainly excitement amongst the insurers to look at these opportunities. It's, as you know, from a banking perspective and from an insurance perspective, it's been a long time coming in terms of getting the regulators to overturn a decision that took place in 2010. I know you've been at the forefront of those pushing the regulators to overturn the decision. So that's a huge first step initially. Yes, there is certainly interest in the market. You will see more capacity in the market as well. I think at first the insurers want to assess this process a little bit tentatively, but once they get comfortable with it, once they see a good flow of transactions, then I think they'll certainly ramp up a lot more. And we see that throughout the region as well. There is a lot of capacity in the market, a lot of interest as well. In regards to transactors, yeah, it's a great move for infrastructure because the infrastructure business, it's a heavily capital consuming business for sure. It uses up a lot of capital, as you say. And I think if you look at in India in particular, yes, it's heavily driven by government entities being the principal parties involved in the construction and contractor industry. And there's obviously delays that occur in this. There's a lot of red tape, as you know, within the market there. Unfortunately, I think that'll work out as we progress. But it occurs in other countries as well. Latin America is a good example of that also. So no, I think it's something where the industry is excited about it. They will look at inquiries, they will look to expand and look to cover risks as they come on board. So certainly it's a positive.
Perfect, sir. Thank you. I think one question which, so broadly what I understand is obviously the industry is pretty excited. I'm pretty hopeful that this will pick up. Yes, it will take some time because industry has to learn how contractors work when it comes to financing side. Abhishek have been asking me a question about what the benefit a bank will drive. So Abhishek, over to you.
Thanks, Akshay. So for the general information, this is one question which has been asked again and again, is what is the benefit a bank derive by using insurance? Basically, how the mechanism works. That is the question.
Yeah. Thanks, Abhishek. Very good question and one that's asked a lot. So a number of different key reasons. Some of the most popular ones. And we've seen this come more into play, I would say, in the last 5 to 6 years, is for capital relief purposes. So through having a policy that is capital relief, it's BAL compliant. That then allows the bank to actually allocate their assets internally elsewhere within the bank. It frees up their assets effectively. So that's a huge positive that banks can attain from that. We see that more used by, I would say, European banks in particular, capital relief wordings. But it's something that we see that US, North American banks, and indeed Asian banks will start to apply more and gain benefit more from that as well as we move forward. That's one reason. Another one is it increases the risk appetite of a bank. So, for example, there's only a certain amount, even on a very good obligor or a very good contractor, that banks can take as clean risk on their own balance sheet, no matter how good that quality of the risk is. So what they use insurance for is to then offlay that risk onto an insurance company, so that then enables them to actually take on more risk overall holistically. The other point is it can allow risk distribution and improve risk distribution for banks, and also allow them to sell down a portion of that risk to other financial institutions as well. So certainly those are probably the key areas why banks acquire insurance in that regard.
Thanks, Tyler. I think that brings me to one question which I've been asked by 2 or 3 of people who are pretty involved in this line of business. What they're asking is that what idea is allowed is the assignment route. Okay, but in my experience of doing structured finance from last 8 years since I joined Marsh, what I understand, banks prefer to buy the policy all by themselves, rather having an assignment route. Do you think that the forum over here and the industry should be representing it to the regulator by that for contractors, especially if banks can themselves buy the policy, that would be better? Just wanted to understand why bank prefer having a policy by themselves rather having an assignment. If you can just throw some light on it.
Yeah, of course. I mean, one of the key reasons is really operational risk. So the banks themselves, that they'd want to be sure that the premium is being paid, that all of the terms and conditions are being met, and all of those really, really key requirements to ensure that any potential claim is subsequently paid. if they themselves are the owners of the policies, then it's up to them to ensure that those risks, those conditions are being met. If they're only assigned as a loss payee or something like that on a particular policy, they don't have those rights and they don't have that access under the policy to do that.
Yeah. So broadly, so one is mitigating operational risk. I also think because normally most of the banks have their own policy wordings, which is through their legal. So I think that gives them comfort. They're buying on a wholesale, so obviously the relationship goes bigger. So I think that is the reason why banks are more comfortable buying the policy. Thank you, Tyler. One last question. Actually, this has come in the chat also, and then we have questions. One, this is more specific to current situation. Tyler, you have worked in US, in Asia, across the world on various structures. See, the banks in general have been in a hiatus in COVID, and then we had things like Evergrande in China. The financial market was limping back. Things were looking good, and then we had this Ukraine-Russia. Sorry to involve China in this Ukraine-Russia issue. And what challenges are you thinking? Because on one side we have Indian market, which is like bubbling with opportunities. But at the end of the day, the bank is having exposures across. They learn from their past. There are corrective measures put in. How do you see this whole thing in short term and long term? What would be the implications?
Yeah, it's a good question actually. I mean, I think the banks, like anyone else, really are following the global economy. And obviously, there was a severe downturn in 2020 initially that was factored in. Huge amount of stimulus, monetary funds, rescue schemes came in, furlough schemes, etc. So then the economy was really there was a surplus amount of cash in the economy, and as we saw in 2021, yes, the economy, as expected, did certainly bounce back. The number of, I would say, non-performing loans that banks had sort of set aside did not really materialize. And everyone's of the opinion that there will be probably more of a downturn, especially if you factor in or you base it on how businesses are performing and corporate insolvencies as well. Those have really dipped in terms of the numbers in 2020 and 2021, just really because there was a lot of excess capital in the market. Now what we're going to see on the back of that, there'll be an increased number of corporate insolvencies, probably later on this year, if not moving into 2023. And I think everyone, both the insurers, the banks, they're all worried, they're all concerned about this because it's been quite a benign period, at least the last year and a half as well. So I think what we're going to see is there's going to be more concern. There's going to be more banks and also corporates as well assessing insurance as a solution for them to trade in a more secure manner, especially in markets they're not aware of and where they can actually seek to improve their cash flow as well on a secure basis. So we'll see an uptick in I think companies and also banks assessing insurance as a tool to help them grow securely.
Yeah, so short term, I believe, there would be maybe some caution, but in long term, things look good. So with this, thank you, Tyler. I think now we can have all the panelists. We can open the forum for Q&A. We have about 4-5 minutes left, and we can call Lynn, Mr. Chandrapal, and we can take questions.
Yeah, thank you, Akshay. So we have answered most of the questions during the webinar, but yes, there are some questions which we definitely want to talk about on this forum for the benefit of all the participants here. The first question that I would like to take up is on the recent issue, which is what is the impact of Russia-Ukraine conflict on the surety bond market across countries? Are political conflict between countries are forming part of such surety bonds products being introduced in India?
Lynn, would you want to address this question? Basically, Russia-Ukraine conflict and impact on surety market.
So at the moment here, I'm talking from an Africa perspective. It's business as I think the spotlight is on Africa. Okay,
Correct.
so for us, it's still business as usual. I want to take make light of this crisis and say, hey, but Africa, we're still happening on this side. So I think to our benefit, if I can answer that question, it's actually move focus to Africa. So as it stands from an Africa perspective, and that's what I can talk through, is that we have not seen any negative impact to date.
Personally, I also feel there will not be much impact. Chandrapalji, you have any thoughts on this? Will this impact surety market? I know you are on mute. No. So broadly, Abhishek, till Chandrapalji come in, broadly it will not have much of impact because for India it's a fresh start. So not much of impact of this. Yes, political risk wise, obviously underwriters will have claims. So they will be cautious, but the set of underwriters who write political risk and the set of underwriters who should write surety, they're a completely different set of people, different capital. So no, not have much impact on it. Next question.
Thanks. So the next question which I would like to pick up is, what is the way forward? Are the insurers ready with the product? Can we expect the product to be up and running maybe on the 1st of April?
Okay, I can address this. So frankly, yeah, market is not yet ready because they were caught napping. I think industry was asking for it, and certain people like Marsh, there were some other people also who were keen that this should be bought in. Government was equally keen. I think this has come in more from Ministry of Road and Transport, Railways, as well as Finance Ministry. They wanted this product to be there, so the product is here. Market is figuring out way. I don't think so 1st of April, though it will start, but it will come in. Probably in H1, that is before June, we may see first or second transaction of surety in India. Yeah.
Thank you.
Just one point, I think Rishabh just shared me one question. Do insurers have an at par recourse to recovery as bank has under the insolvency code? No, that's not the case. For the simple reason, and I think this is one of the asks of insurance market. They want to have the status of a financial creditor because, see, if you look at from, and Tyler will suggest the same, and Lynn, if you look at from the perspective of capital for insurer, they are not worried about a loss of 10, 20, 40, $50 million. What they are worried about is a long legal process. They would want it to be resolved. Yeah, Chandrapal, you will agree. I think that is one area where you will. I think this is where indemnity part, which Lynn was referring, it took 1.5, 2 years to get first indemnity document signed, was this to understand, acclimate to Indian legal system. I think that is where probably the concern was. And if a financial creditor position is provided, IBC's scope is increased, I think that will help the industry immensely.
Thank you. Thanks, Akshay. The next question, because we are running short of time, we have just 1 minute ahead of the scheduled time, but I would like to take up 2-3 important questions currently. Everybody talks about in India that how the international market has been performance when it comes to pricing. So if somebody has to ask all of the people who are present here that how has been this product performing in the international market? What type of claim ratios are we seeing in the international market?
I think Lynn can give a Africa perspective, which is one large market. Lynn, what type of losses are insurers and reinsurers seeing in sureties?
Okay, so we've had the state of our construction industry in South Africa has pretty much been on a downhill. We've had a few liquidations, and we've had a call up on a few guarantees on construction projects, on 1 or 2 power projects as well. So we have seen a few claims, and that was on the continent. From a South African perspective, again, that you alluded to indemnities, this is where it comes in. And again, the most, a painful part, but it needs to be perfected because this is when insurers will showcase, listen, there's our recovery, and this is what we've done. So yes, we have seen claims, and you see the stakeholders rallying together, be it the contractor, beneficiary, in some instances trying to find another contractor. Insurers will try and see if they can get another contractor in to complete the work. So the insurer, and I think this tripartite agreement where surety is, the insurer and the client have an aligning interest, right? That means it's our client. That means they don't want the guarantee to be called up, so they want to work with you. Whereas the two-party agreement, the surety is completely different. So this aligning interest is that they want to work together, and they want to so in some cases, like I've said, we've found insurers have found other contractors to step in and to try and complete that. So yeah.
Thanks, Lynn.
Just
So my last question would be to Akshay. Akshay, you have always been quite helpful whenever it comes to any discussion with respect to surety,
always.
political risk. But we all would collectively want to understand, and this is a question coming from the client, that what would be the underwriting information that would be required, whether it will be a short question that can be answered quickly and we can get into procuring terms, or is it going to be similar to other contracts where it's going to be really lengthy for somebody to arrange those information on the first
No, so Abhishek, I think I can obviously answer it, but I would pass it on to Mr. Chandrapal, because he has provided that information. nobody would be better equipped to who can confirm that, okay, this is the information required, this is what they asked, this I never gave, but still I was able to place it. So Chandrapal ji, over to you.
Chandrapal ji, I believe you are on mute.
No, he's not on mute. I don't know. His voice is not coming.
Okay, Akshay, you want me to run with it?
Yeah, maybe then you can take it up. Yes.
Okay, so surety, it's something maybe everybody can remember. It's the 3 C's for underwriting, okay, where we look at capacity, we look at capital, and we look at character. So when we talk about capital, right, that is it's directly linked to the financial, the performance, okay, of the client. So that's the first part in terms of the financial resources of the company. Again, Akshay, you mentioned earlier in the presentation, it's just not that alone. Surety is looked at holistically. So these 3 C's are important. So the capital, which refers to the financial resources of the company, then the capacity. When we say capacity, we mean the company's ability to handle the project, to execute the project, okay? What's his past experience? Has he built bridges before and now he's bidding on something completely different? So that talks to capacity. And then the other element of C is the character. Character is the basic operations. It's staff, it's the management, it's a reputation of the contractor finishing these jobs on time and successful execution. So when we look at the paperwork, right, like in any, like with the banks as well, so there's a ton of paperwork, right? So it comes without going, maybe in India, we can get it right. We can possibly have and put to the regulator a short form, right? And try to make it less, our application forms here, Akshay will tell you, is about 7 pages. It's a whole facility form where you underwrite according to these 3 C's, and then it's project specific, right? So in addition to looking at the holistic view, they then analyze that specific project, be it the country, beneficiary, all the parties involved there as well. So there are application forms. But again, if you remember the 3 C's where we look at, your past, your pipeline, and the financials, linked to the financials, and then obviously your successful execution of previous projects. So yes, unfortunately,
this is the beauty. Every time I interact with you, I learn something new. Means though I've been collecting information, but this 3C I'll remember. I think that was easiest one. Chandrapalji, is your phone? Can you now speak? Can you just? No, I don't think so. Sorry.
I believe there is some technical issue with Chandrapalji, but thanks a lot. It's a big thanks to Taylor, Lynn, for being here in the panel and answering to most of the questions that Akshay and I have asked you. I would like to give a special thanks to Akshay for helping us structure this particular discussion. And a very special thanks to all the attendees who have been quite patient, even though we have exceeded our time limit. But a big thanks. This has been a discussion point for most of the discussion that we are handling with large contractors. And we are really excited that we are going to see this product very soon. And we will be more than happy to take any of the questions. Even after this webinar, we have tried to answer most of the questions that was there on question answer tab. But if there is anything else, you can just post it to us and we will be able to answer that one-on-one to you. Post the webinar, we will also be sharing our presentation with you for your ready reference. And we all are looking forward to see this product. And I'm sure that along with Akshay, I'm also really excited because most of the clients, including some of the clients whom I service from the construction domain, are going to see benefits from this surety product as a great alternative alongside the bank guarantees. So thanks a lot for joining
Thank you.
in. Have a nice day.
Thank you, Abhishek. Thank you, Tyler. Thank you, Lynn. Thank you, Chandpalji.
Thank you. Thank you, everybody. Have a great day. Have a nice evening. Take care.
Yes, bye-bye.
Bye-bye.